Welcome to the Risk Reversal Podcast. I am Dan Nathan. That is Guy Adami. We just got done with Fed Chair Powell, his presser, the rate decision. Guy, you and I, we're going to do a quick breakdown, maybe less about what we heard, because I don't think there were any big surprises. Maybe we'll focus a little bit also on the market's reaction, because we did have some volatility in the stock market. We had some volatility in the rate market, but we're basically right back to where we were. It is basically 25 minutes to the close on Wednesday afternoon.
And the S&P is unchanged. So, we'll walk through it. The initial reaction, a little after 2 o'clock, were to take the S&P to new all-time high, 66.26, and then followed by a pretty precipitous decline down to 65.50, basically. So you can do that math. I mean, that's like a 70-point sell-off. And now here we are at unchanged to slightly higher, as you say, about 20 minutes left in the day. I would love to say that something came out of it that was sort of earth-shattering, but I don't really, and the market suggests not so much. And 25 basis points was baked into the cake. Mr. Mirren, I believe that's how you say his name, he was the one person that voted for a 50 basis point cut. But as Danny and I said, I think yesterday, seemingly a bit of an audition for the next Fed chair job. So I don't know if there's a lot there you can discern other than it's pretty much what the market expected. And I think this lack of reaction, at least as we're sitting here now, sort of gives credence to that.
Well, you just used the term auditioning for a role, right? So Stephen Mirren was just, approved or Senate approved for one of the governors, and he literally got in there yesterday, right? I can only imagine what that meeting was like, especially with Lisa Cook in there. Can you imagine? Honestly, it just would be fascinating to be a fly on the wall in there. And, the thing, though, that is interesting is that Governor Waller and Governor Bowman, which both dissented at the last meeting about not cutting, did not dissent this time. And so, there was a lot made of that last time. It's like how infrequent it is that you'll have two Fed governors, dissent. And, one of the things that the panel on CNBC said prior to the rate announcement was that Fed Chair Powell likes to build consensus, right? And so it is interesting that he kind of corralled those two, that maybe those two got the 25 basis point that they wanted, and maybe they kind of wanted to step out of the way because Mirren was going to do his thing, and maybe they don't want to be lumped into him if they're all, interviewing for, like speaking to an audience of one for whatever that's worth. But it also suggests that they're willing to back this notion of an independent Fed and not be influenced by the executive branch, which I think is a good thing. Thoughts on that, Guy, because, you're going to continue to get, and I don't know what the president is tweeting about or saying, that sort of thing, but there's going to continue to be this kind of push and pull about what should be done, and really specifically what the White House wants to be done.
Yeah, and that's the part of the problem, right? You can make an argument that the Federal Reserve, have been doing everything right. People say they're late. I mean, they're always going to be those people. Of course, now with the additional rhetoric around it, you'll have people out there that say they got bullied into this rate cut by the administration and all these different things. I mean, the reality is the reason why the Federal Reserve needs to be independent is for exactly those reasons. And, more and more people will say, well, how can you have an independent Fed when they are appointed by the president and all things are political? I mean, I get it, I guess, to a point, but it should be at least one of the few remaining institutions that sort of does it on their own without the input from either party, quite frankly. And unfortunately, I think we've jumped that shark a long time ago.
Well, it is worth noting to your point about, the executive branch, you know what I mean, nominating a Fed chair. They have to be Senate approved, right? And what did Powell start to do right out of the gate? He started normalizing interest rates because we had come off that zero interest rate bound that we were on. Isn't that crazy to think about how long after the financial crisis, interest rates were kept that low, and we had quantitative easing that in some way, shape, or form continued. Listen, this Fed chair has been through a lot, right? Almost immediately in 17 and 18, he's getting blasted for the rate hikes, right? Then we have COVID. And I think for the most part, everyone's in agreement in the throes of that crisis that you're going to cut interest rates. That's the playbook. They went to zero. They kept the economy afloat there. Obviously, there was a lot of fiscal policy that was in there, but then you almost immediately had asset bubbles, right? And those were the sorts of things that were happening along with inflation. And you could ask yourself, well, is that more about fiscal policy than monetary policy, right? And who knows? And they all had something to do with it. But for all intents and purposes, they kind of slayed that inflation dragon, whether they were transitory, whether that was meant to be transitory or not. Your definition of transitory is as good as mine, whether it was meant to be 9 months or 9 years, you know what I mean? Who knows? So here we are. One of the things that he mentioned, Guy, was that, the economy is doing okay, 1.5% GDP. He said maybe a bit better. He called this a risk management cut of 25 basis points. He did not suggest that a 25 basis point cut is going to fix any problems. If they say that, or they think that, the risks lead or lean towards a weakening labor market as opposed to inflation picking up. He also spoke about the thing like tariffs and immigration. These are all things that they did not have clarity on 4 months ago, right? So if you think about it, that's where the Fed is right now. And you know what? The markets are telling us it's okay. The 10-year 4%, the stock market's at all-time highs, right?
Well, that's exactly right. And through the lens of the market, everything is fine. And okay, I mean, at all-time high, effectively in the S&P, you can say that they've done their job. But you mentioned the word transitory, and it has a different meaning for everybody. I understand it, but when they first uttered that term, I don't think in their wildest dreams they thought it would be the year 2028 where inflation gets to the 2% target. By the way, that's what they just told us. They said the new projection shows inflation will finally return to the 2% target in 2028. So if that's your definition of, I'm not you, Dan, but if that's the definition of transitory, then you're right. I would say when they said the word transitory, they were talking about months, not years. So there you go. So inflation, obviously, to me, is still a bit of a problem. I mean, I think they've sort of bent over backwards to say the labor market is concerning. It's more concerning than inflation. We're going to start to target that. And they're jumping through some hoops here. And to your point, though, the market seems to be giving them a huge pass. And at least through that lens, everything is okay.
Yeah, so this is something I had not heard before. Someone asked the question. I think the question was in relation to maybe the executive branch, how they felt about the Fed's dual mandate, right? So that's full employment and stable prices. So it's the labor market and it's inflation, right? And so they asked the question about a third mandate, which is moderate long-term interest rates, which I thought was interesting, right? So what is moderate long-term interest rates? Well, it's getting you to that neutral rate, right? And so what Fed Chair Powell said is that if we do or we try to achieve the maximum employment and stable prices, that will lead to that. But he said that will lead to moderate long-term, interest rates, which all makes sense. I just don't think that, I'm not an economist, but the idea of changing the Fed's mandate to kind of put that in there, that's almost a political comment, right? Like that's basically saying we don't want to have excessively tight monetary policy, basically ever.
Yep. I think that's fair. I think a dual mandate is difficult enough. I think if you add one more variable in, it just makes the job that much more difficult. I mean, there are people that argue that the Fed should be there for just emergency circumstances, emergencies like we've seen in '08 and '09, emergencies like we saw, I think, during COVID, obviously. But other than that, I mean, let the free market decide. I mean, I sort of favor that, although I'm not saying, going full bore that way, but to make it a little bit more political and to add one more variable to the equation, I just think it's making a difficult job almost impossible.
Yeah, and so if you look at the dots, they're expecting two more 25 basis point cuts this year and maybe only two next year, Guy, to get to that kind of 3% neutral rate. So, the fact that the markets, maybe they just have a bit more clarity about that, right? It's not going to be any jumbo cuts or that sort of thing. But again, they're on watch for a weakening labor market. let's talk about what groups are acting okay here, guys. You have large cap banks. The BKX is up about 1.5%. You have regionals up about 1.5%. The yields we talked about it. There was some volatility, but you have a 10-year basically at 405 right now. You have a 30-year at 466. These are the sorts of things a lot of folks were keeping an eye on, because if you cut, or if you give the outlook of more than expected, Fed funds cuts, right? Then you run the risk of restoking inflation. And then on the back end, the long end, you're going to see those rates kind of move higher.
Yeah. So I was focused on, I wanted to see what's obviously happening in the bond market. And to your earlier point, bonds rallied initially, then they sold off initially. Now they're sort of flirting with unchanged, but the currency moves I thought would be interesting as well. And you saw a pretty big rally in the dollar against the yen. Dollar euro had a similar move, but's given it back. So I don't know what to make of this. And there's certain groups, certain sectors that are outperforming right now, but I still think the market is trying to digest all these things. And again, everything that we are talking about right now was theoretically it being anticipated by the market. So I don't think Jerome Powell, either in the questions or in the commentary, said anything that's going to sort of change that narrative. Now it just comes down to, what is the next catalyst for the market? Because we're obviously through this Fed meeting, we're through earnings. Is it a trade deal with China? I'm not necessarily sure, but I think the market is still trying to digest this, and it's trying to do so, by the way, at an all-time high in terms of the S&P, and through certain metrics at an all-time high in terms of valuations.
Yeah. So back to the banks for a second, Guy. Maybe we can talk about what it means for like net interest margins, right? So you have this near term cut. You have longer term yields kind of hanging in there a little bit. The KRE did rally, I want to say a couple percent after the announcement, and it's given all that back, and it's below those sorts of levels, but still up 1% now. It's coming in a little bit. For banks, we're supposed to have all this deregulation. Do you remember this, like coming into this year? One of the strongest groups was the regional banks, and the idea that they're going to be allowed to kind of M&A and merge, and some of these capital requirements were going to change. This group never made a new high relative to the S&P. It's acted on a, relative to, let's say, the BKX, the large cap banks. It's never, really kind of kept up in performance, especially off of the April lows. But I think not confirming the new highs, Guy, in the S&P 500 maybe says more about their inability to kind of keep up with some of the expectations, since the election into the new year. Because so far we haven't seen anything that would lead you to believe that these banks are in a stronger position than they were, let's say, a year ago.
Yeah, I'm not certain they are. And you mentioned the KRE; those are regional bank ETFs, and obviously that's a big component of the small caps. But this is a podcast. We'll do this on a market call just so we have the visual. But if you look at the KRE, I will tell you that it made its first all-time high in the summer of 2018, and then sold off, like many things, pretty precipitously into COVID. It had a significant rally in the middle of 21, 22, probably on the back of all that liquidity that was coming into the market. I think it made an all-time high around 80 or so, and then, like many other things, plummeted into the spring of 2023. I only mention that because this high that we just saw recently, around 65, 65 and a half, that potentially could be the other shoulder of a Head and Shoulders. And this goes back again to 2018. So I'm glad you mentioned sort of the lack of performance, because over the last year, if you look at the KRE, it really has not participated nearly to the extent that the broader market has. So this is something that I think you absolutely have to watch for underperformance going forward.
Yeah. It would be a group that would be sort of disappointing when you're thinking about the potential for economic growth, right? If you think about small businesses, you think about, the effects of tariffs, you think about hiring in that group, right? There's a whole host of things. A lot of these small businesses are probably being hurt also by some of the immigration policies. There is something to be said that one of the big cases to be made for Trump into the election was a stronger economy, right? And the economy is not weakened per se, but some of the things that they've done, and I think it's important to remember, I think you were saying this at the time, they told you they were going to put in, more so during the transition, they were going to put in tariffs. I think the issue in April was that no one thought they were going to be that draconian, right? And they told you that they were going to have mass deportations, right? But I think a lot of folks didn't kind of believe it. Now, let's just be honest, they actually haven't done nearly what they said they were going to do, but the places in which they did it are actually hurting parts of the economy that have actually driven prices up. And then the flip side of that, a lot of this policy has not been good for manufacturing. If you look at some of the weakest parts of the labor market, it is manufacturing, because right now, and Fed Chair Powell said this, guy, is that he was asked a couple questions about this, is that who is bearing the brunt of the tariffs right now? He said in some instances it's the exporter, but the importers or the retail, whoever are, they're not passing through the cost yet to a consumer. They were all, but insinuated that that will be the case.
It's coming, right?
Yeah, someone else asked about FICO scores and auto delinquencies. These are things, again, that you've been talking about. So it really feels like the back half of this year, or as we get into the last third of the year, could be one of those things that you see some speed bumps. But someone else also mentioned, look at the retail sales that we just had. So some of these things are really at odds with each other.
No question about it. And if you go back to earlier in the year, Peter Bookvar talked about all this data is going to be very lumpy going forward, and that's proven to be the case. And what you just outlined is proof positive that that's the case. But I think the one takeaway I have from that is the fact that tariffs have really not factored into the inflation equation yet, which begs the question, is it just a matter of time before it does? Now, the optimist will sort of say, you know what, that's going to be a one-time thing. And yes, we know it's coming, but don't take that in consideration. The pessimist will say, wait a second, we have an inflation problem already, and you're just going to sort of tack on the impact of tariffs in the next couple of months. And then what are we looking at, and why are we cutting rates? So that's why this becomes so confusing. And that's why, again, I look at an S&P at an all-time high, given the valuations that it's trading at, given some of the metrics that I look at, given some of the softness in the economy. And I'm like, man, oh man, it just doesn't make a lot of sense, other than the fact that, there's this passive flows that continue to make their way into the market. And I think market participants, for the most part, have learned, what, sell-offs, you want to use the word transitory? That's what sell-offs have been, transitory. And that's actually a good use of the word.
Yeah, he was also asked a couple times about AI, and so the capex spend and the contribution to economic growth. He did mention on a few occasions that nobody knows like how long that's going to go and the sort of impacts of that. But I think it's interesting that that is something that they're going to continue to get questions about. There was definitely some commentary from some economists on CNBC after the print, but before the presser, talking about productivity gains and really some of the offsets that you might see there, right? So, again, we won't know. I just think on the AI front, guy, if we're looking what's going on today, we have a situation where Nvidia is down a couple, 2.5% or so, down more than that. The Chinese are basically telling their technology companies not to buy Nvidia chips. This is on a week we're supposed to have some, I don't know, at least the way it's been previewed, some good news on that front. I think the good news was potentially the TikTok deal, but there is no deal that we know of. We've just been told that there's some sort of arrangement where Oracle, Silver Lake, and Andreessen Horowitz are going to own this entity, if you will. And then on the other front, I mean, it just seems like, earlier today, and we'll put this in the show notes, Marco Kolanovic, our friend, had a tweet out by basically saying that if this AI trade, and he named, Oracle and Palantir and Nvidia, and maybe there's a couple others, comes undone. I mean, he used the C word, guy. He said we could crash. So like talk to me a little bit about that, because we know the concentration. People are sick of hearing about it, right? But
Well, yeah, the concentration, we talked about this, but if you're just listening to the podcast this week, and this is the one you're listening to, those handful, 6, 7 names now have a market cap that's larger than the economy of China. I think China's a $20 trillion economy-ish, and those handful of stocks have now surpassed that, which, I don't know necessarily what that means, but it doesn't make a lot of sense to me. And then, quite frankly, you add a couple more names in there, and you're approaching the market cap or the GDP of the United States, which is probably approaching $30 trillion or so. So, the enthusiasm around these names, just in terms of the valuation the market is giving them, doesn't really make a whole hell of a lot of sense to me. I mean, people say it's different this time. It's not. I'll tell you what's different this time. The magnitude of the numbers is different this time, but the rhetoric around it is not.
Yeah, agreed on that. And to your point that you made earlier, like, what are the catalysts for the markets right now? Because we're through earnings season, we're through this Fed meeting, I guess, inflation readings and all that sort of stuff. But it just feels like a lot of that is in the rear view mirror. All right, the US dollar guy, we highlighted the Dixie. It's almost back towards those April lows. And we have a situation where yields and the dollar were the things that kind of really freaked out the White House, which is kind of why they pulled back a little bit. We had that taco trade, but you see gold has come off its highs a little bit. You also have Bitcoin that is sold off. Talk to me a little bit about the relationship between the dollar that looks like it wants to go lower, right? Yields that are kind of stuck, but you have gold coming off the highs. And by the way, I don't know if you saw this. Greg Ip in the Wall Street Journal today had a story about why everyone should own, and then in quotes or something like that, some gold. I think it's interesting that you're starting to see that sort of stuff with gold at all-time highs.
Well, central banks have got that memo a long time ago. And, you mentioned the dollar and today's action, at least the action post this Fed presser meeting, whatever you call it, has done nothing to change my view that the dollar will continue to head lower. I mean, maybe in the short term, you get a little bit of a bounce here, but at one point today, you saw dollar euro, I think, surpass 119. That's a level we haven't seen. I want to say go back all the way to sort of 2021 or something like that. You have to go that far back when dollar euro is 119. So I think that's headed to 125. Dollar yen has bounced a little bit. I think it was trading about 146 and three quarters ish. I think that's probably headed below 140. So this dollar weakness is going to continue. Yeah, you have a little bit of a sell off in gold today. I don't think it's anything to be all that concerned about. In my opinion, you had an initial spike, then a bit of a sell off, but I think the gold trade is intact. And, at least everything that I've heard over the last hour or so, to me, it's nothing to change my view that the dollar's headed lower, gold's headed higher. I still think rates go higher despite what we're seeing over the last hour or so.
Yeah, and we've been talking about that consolidation, if you will, in gold that really started in April after that big run, right? It was a kind of a flight to quality when we had all that volatility, and it really went sideways just kind of under 3,400 ish, right? And then all of a sudden, in mid to late August, it just took off. It went up 11%. Just think of that. I know you've traded gold for like, 30 some years. That is a huge, huge short. I mean, it really is. It's like a massive move. So gold was going higher as the stock market was going higher. That's not something you usually see. The stock market was making new highs every day and gold keeps ripping.
Yeah, you don't typically see that. It was trading along with other risk assets, but in some ways, and I will continue to say this, it's trading as if there is severe risk to the market that, for whatever reason, the stock market is not taking into consideration. I think gold, to me, the move that it's had in the wake of yields up, yields down, dollar up, dollar down, any basically situation you can come up with is signaling something. And the thing that it's signaling to me is not particularly good. Now, I've said that for a while. It has not been correct. The gold side of the equation has, but what it's signaling has not. But there's still lights flashing in terms of what the gold market, I think, is trying to tell the rest of the world. And we've mentioned it, but it's worth mentioning again in the last couple of minutes. Central banks now own more gold than they do treasuries, I think, for the first time ever. And ever's a long time.
Yeah. All right. So into the close, we got a minute left or something like that. I mean, the market's going to, S&P is going to close down maybe 17, 18 basis points, and the NASDAQ's going to close down 40 basis points. You think about a rate cut, the first in a year, and there's really not a whole heck of a lot of volatility, in and around most of the risk assets that we look at. What would you expect, the move? What sort of follow through do we get tomorrow? Because as far as I'm concerned, it wasn't like some people were saying we could have a hawkish cut, that sort of thing. There could be more of a signaling of a sustained rate cut, sort of thing. I don't think we got any of that.
I don't think we got any of it either. So it's hard to answer that question. I mean, historically, the move that you see in the aftermath is offset the next day in spades. but you haven't seen a move today. I mean, the S&P, as you just said, is basically closing unchanged. So it's hard to figure out one way or another. But what I will say is, the weakness in some of these semiconductors, specifically NVIDIA, there's something to watch there. And now that the baton has been passed from this much anticipated Fed meeting into other potential catalysts, I think, look, I'll say it again. I think NVIDIA is shown its stripes. I think that's headed lower. I think the gold market is flashing red. I think you could see a sell off in the bond market over the next week or so.
Yeah, last thing I'll just say in and around that AI trade, there's two gaps I really want to keep an eye on. It's Broadcom is down 4% today, that huge earnings gap, and the other one is Oracle. And if you start to see those being filled, the underperformance that you're already talking about, NVIDIA, other than all of this great news, all this data center spend, we just heard all those folks who are investing in the UK. We've been in the last month reiteration or like a raising of those capex from the big hyperscalers. NVIDIA did not make a new high. So again, I'm with you in that camp. All right, guy, we did this. Again, this is maybe we'll start to do this a little. Wapner has his gun lock thing every Fed meeting. Maybe you and I, maybe this is what you and I do right after the Fed meeting,
Why not? I'm
right?
up for it.
All right, peeps. Thanks so much for being here with us. If you're listening to this on Thursday morning, check us out, 11 a.m. Guy and I have Liz Thomas of SoFi with us on the market call. You can watch that on our YouTube channel. And you know what? What should they do to that button on the YouTube
Smash it.
channel?
Smash the like button.
Yeah, smash
Smash
the
it.
like button. All right, peeps. Thanks so much.